Hello Baker Finance students. We are now approaching week 4. At the end of the week 4, we're going to already be halfway done with the course. So you guys are doing great. Just keep plugging along. Hopefully by Monday and Tuesday I should have the exams graded and the homework graded. So just keep plugging along. I really enjoyed all the posts and the forum discussion this past week with whether markets were rational or irrational. So yeah, I think it's a little bit of a mix, when you definitely have to consider both schools of thoughts. And as we saw in the video, they're both strongly opinionated about how they feel about it, but they do respect each other in their opinions and their theories. So, well, this week, it's a little bit lighter week, give you a little bit of break, and you're going to have 2 chapters that you need to read, or actually 3 chapters, but we're going to have 9, 10, and 11. And you're going to have a forum discussion. In that forum discussion, I want you to pick something you've done in a work currently, or work in the past, or if a nonprofit, any type of investment decision or some way to think about reducing cost, and describe how the decision was made and what were the results, and what did you learn from that experience. So you can look at those details in the week 4 forum discussion. I provide an example where I work at Avila University that we used about a year or so ago when helping us build residence halls. And for the most part, I think it turned out well. We definitely have increased student presence on campus, but always we're worried about setting the right price and making sure we get enough kids that want to stay on our campus. So, all right. So as I look at my notes here, in this week in Chapter 9, we first start off with the discounted cash flow analysis. If you like to think of this as cash is king in finance. So the accountants might say, what do you want it to be? Well, finance people say, I want to know, where's the money? Show me the money. And we have to, factor into such things as reversing out when does the cash actually happen? When do we receive this cash? So, but the idea is kind of following up with these projects. If I'm trying to create these pro forma statements to try to predict the future, then I need to have an accurate look at how cash is going to be generated. And as they mentioned, there's 3 different methods that they have. I think the easiest way is to get to net income and add back depreciation, because we noted that depreciation is a non-cash item. There are different reasons, that we think about this too. We have to separate investment versus financing decisions. The way that I want you all to think about this is, imagine if you owned all the bonds of the company and all the stocks. You have provided the capital. Now we're just kind of looking in terms of opportunity cost and whether this is a good project to take on. So, how we finance it should not matter. It's the investment decision. All right, getting into Chapter 10. You're going to look at such things as capital budgeting decisions. We every year have to make decisions about purchases that are required or investments that are required by law. I work in disability services at the university, so if there's anything that we need to be in compliance with ADA, I have to make sure that I tell the budgeting committee that we need to include an expense for this. We need to, especially if we're doing new construction, I need to make sure that we're in ADA compliance. Other expenditures could be for increased capacity as your business is growing. And probably the most fun one of the topics of the textbooks is those that are kind of the new and exciting ones. I see this opportunity out there in the market, and I have an idea, and I'm going to go out and invest in a particular product or service, and I've done all the numbers and it looks to be good. So we go ahead and we kind of have to make decisions about which projects we want to take on. Other examples too could also, I could mention about cost reduction. I think about in Home Depot how they have the set of cashiers. They might have automated checkout machines. Somebody would have to crank through and do some numbers and say, yeah, it's well worth it to do this in the store. I remember one of my Baker students in the past in my Walmart in Lee Summit, the reason they decided not to have these automatic checkout machines because it was theft reasons. So it would have saved the company a lot of money, but they'd have to think about all the product potentially walking out the door. So, okay. And with that, they also discuss what we call sensitivity analysis, scenario analysis. With sensitivity analysis, and they give some examples you're reading, it's that I change one particular variable and I see how that impacts the bottom line. and then I can calculate different net present values. So they kind of go through the textbook and they say, hey, here's the normal scenario, but what happens if fixed costs go up or my variable costs go up? Again, it's just one item and how that one item impacts the situation, because any CFO or any CEO of a small or major company, if you pitch these ideas and projects to them, they're going to know that fuel costs are going to come in different potentially. Labor costs might come in differently. The amount of money it took to get the project started could come in differently. So they're going to be very reluctant to just agree with you that this is going to be exactly how it is. They want to know the what ifs. So you have to also, in addition to present the numbers, you have to say the sensitivity analysis. Well, if these things happen, this could impact the project this way. So it gives management a better idea that, I still feel comfortable. These are the different probabilities of these events happening. And we could use simulation analysis and scenario analysis, a little bit dealing with statistics and probability, to say, hey, what's the likelihood that the economy is going to be strong, that it's going to be weak, or it's going to be about the same? And then I can feel more comfortable about going out and investing millions of dollars or sometimes $1 billion in a particular project. Okay, so with that, they're also going to have in that chapter a little bit of discussion about break-even analysis. I want you to think about this as your ability to cover fixed cost, and the textbook mentioned is also depreciation. But just give you a very simple example. Let's say that I open up, I'm renting out some space somewhere that I'm selling hot dogs, and I have to pay $100 for that. That's a fixed cost. Well, if my contribution margin on every hot dog I sell is $2, then I have to sell at least 50 hot dogs to break even. And that's the idea from an accounting break-even perspective. In fact, in your finance textbooks, they draw the relationships very linear. If you take economics, we know that these cost curves are more U-shaped, okay, because that diminishing marginal returns. But for simplicity, they just show them as a linear relationship. And at some point, we'll break even, then we make a wider profit gap each one that we sell. Also, they want you to take into consideration too, though, is that, hey, yeah, that's from just an accountant's perspective, but we also got to take it from an economics perspective, and that's we need to cover implicit cost. So you're going to see another calculation in your textbook that's a little bit more complicated, but if you follow the steps, it'll make sense. And they use an annuity factor in the back of the book to say use an opportunity cost included in the calculation that, maybe I have to sell a few more planes before I truly break even and I earn what we call just a normal profit. So you'll look through those examples, read them slowly, make sure you understand them, because you have some homework problems tied later to those types of calculations. And then lastly, they talk about some real options in the textbook, and they also kind of mention degree of operating leverage. But the degree of operating leverage ties to fixed cost, and by definition, it's any how does change in sales impact your bottom line, your profits? If a company has a lot of fixed cost, high fixed costs, say like Ford or something like that, it's going to take them a while before they break even. They're probably going to have to produce a lot of Ford F-150s before they get to that break-even point. But once they get through that break-even point, they're going to start making a lot of money. So kind of the ability to earn a profit after I've covered all my fixed costs. If you have a lower fixed cost, you can probably break even more quickly, but as I need additional expansion and space or warehousing, maybe those contributions to profit are less. So it's typical large capital firms that require a lot of investment plan equipment are going to have higher break-even points. But it gives the analyst a way to kind of define by what percentage change in profit should happen if there is a percentage change in sales. Okay, and last with that was also the options. Companies like to have options, that the option if they need to abandon, if they need to change something, if I need to switch, or let's say I know KCP&L, many of their plants around here in Kansas City have the option to use both gas and coal. So there's kind of been a movement more towards natural gas because it can fire up right away. But if say coal got really expensive, or if the EPA said you couldn't use coal anymore, being prepared to switch is going to help you with reducing your cost and increasing your profits. All right, last chapter, chapter 11, go over some of that. They talk about risk return, opportunity cost of capital. We think about a return on investment. We think first from a dividend perspective and a capital gain perspective. If an investor is buying a particular stock, they expect a given rate of return. They mentioned about some of the market indexes. They have the Dow Jones, a famous one, but the S&P 500, that's oftentimes used as the benchmark to make a comparison of how I could do. If you go back in time, you look historically at the rates of return. That's what a lot of this chapter does in this book to set you up for the next chapters. There's in terms of rates of return on Treasury bills, they're rather small. It's a very safe investment, but in terms of your market, there's about a 10% average historic return if we go back to the late 1800s. But there's also a lot more variability in those returns, so there's more risk. Okay? So a lot of this chapter helps us kind of identify, by definition, if you think about variance, say if the average market return was 10%, and if you take those variance and you take a square root of a variance, that's what we call a standard deviation. So it might be that between 68% of the time, if I put a whole bunch of market returns into a hat, shook that hat up, and I pulled one out at random, it might say that 68% of the time we might find a return between 0% to 20%. If I go out to 2 standard deviations and I continue that expansion out until I got to 3 standard deviations, I'd be capturing almost 99% of the area of a normal curve. But this is important to us because it definitely tells us that if there's a greater variance in these returns, an investor in theory expects a greater rate of return. It doesn't mean that he's guaranteed or she's guaranteed that rate of return. It's just that if I'm taking on this risk, I'm expecting a higher rate of return. And we'll tie that in our following week. We start to get into the capital asset pricing model. Okay, well that's it for this week. Do jump in there early, that forum discussion. That really helps get things going. I appreciate that. But if you do have any questions, email me. But otherwise, have a great week, and hopefully get some good news of the World Series of the Royals. So go Royals. Take care.